Hello everyone, welcome to this video. In this video, I'm going to talk about real estate investment trust or REIT. So in this article, we're going to learn what is real estate investment trust. So what is a real estate investment trust or REIT? A real estate investment trust is a company that owns, operates, or finances income generating real estate. Modeled after mutual funds, REITs pool the capital of numerous investors. This makes it possible for individual investors to earn dividends from real estate investments without having to buy, manage, or finance any properties themselves. So now, what are the key takeaways of this article? So in this article, we're going to cover these points. A real estate investment trust is a company that owns, operates, or finances income producing properties. REITs generate a steady income stream for investors but offer little in the way of capital appreciation. Most REITs are publicly traded like stocks, which makes them highly liquid, unlike physical or real estate investments. REITs invest in most real estate property types, including apartment buildings, cell towers, data centers, hotels, medical facilities, offices, retail centers, and warehouses. So now, how REITs work. Congress established REITs in 1960 as an amendment to the cigar excise tax extension. The provision allows investors to buy shares in commercial real estate portfolios, something that was previously available only to wealthy individuals and through large financial intermediaries. Properties in a REIT portfolio may include apartment complexes, data centers, healthcare facilities, hotels, infrastructures in the form of the fiber cables, cell towers, and energy pipelines, office buildings, retail centers, self-storage, timberland, and warehouses. In general, REITs specialize in a specific real estate sector. However, diversified and specialty REITs may hold different types of properties in their portfolios, such as a REIT that consists of both office and retail properties. Many REITs are publicly traded on major securities exchanges, and investors can buy and sell them like stocks throughout the trading session. These REITs typically trade under substantial volume and are considered very liquid instruments. So now, what qualifies as a REIT? Most REITs have a straightforward business model. The REIT leases space and collects rents on the properties, then distributes that income as dividends and shareholders. Mortgage REITs don't own real estate but finance real estate instead. These REITs earn income from the interest on their investments. To qualify as a REIT, a company must comply with certain provisions in the Internal Revenue Code (IRC). These requirements include to primarily own income-generating real estate for the long term and distribute income to shareholders. Specifically, a company must meet the following requirements in a qualify as a REIT. First point, or first requirement, invest at least 75% of total assets in real estate, cash or U.S. treasuries. Requirement number 2, derive at least 75% of gross income from rents, interests, and mortgages that finance real property or real estate sales. Number 3, pay a minimum of 90% of taxable income in the form of shareholder dividends each year. 4, be an entity that's taxable as a corporation. 5, be managed by a board of directors or trustees. 6, have at least 100 shareholders after its first year of existence. And the last one, have no more than 50% of shares held by the 5 or fewer individuals. So the important thing is, today it is estimated that REITs collectively hold about $3.5 trillion in gross assets. Publicly traded equity REITs account for $2.5 trillion. Thanks for watching this video, and please don't forget to subscribe our channel.